The Power of Long-Term Growth Investing. Thomas Rowe. Price Jr. transformed the world of investing with a philosophy that was radically different from the conventional wisdom of his time. While most investors hunted for bargains, stocks that were beaten down, undervalued, or temporarily forgotten, Price looked in the opposite direction. He searched for companies that were already strong, already growing, and already demonstrating the seeds of future dominance. To him, the market's most promising opportunities were hidden not in the rubble, but in the momentum of exceptional businesses. Price believed that growth was the purest indicator of future wealth. A company that consistently expanded its earnings, strengthened its competitive position, and reinvested profits into innovation had an almost unstoppable trajectory. Paying a premium for such a business, he argued, was not a risk but a strategic advantage. A great company rarely appears cheap, he emphasized, and he meant it literally. Quality always has a price. Yet what made Price's philosophy truly powerful was not just his focus on growth, but his understanding of time. Growth alone is not extraordinary, but growth multiplied over many years becomes something almost magical. Under Price's lens, compounding wasn't merely a mathematical concept, it was a powerful economic force, capable of turning a small stake into a life-changing fortune. He described compounding as the silent engine of wealth, a force that works quietly, tirelessly, and relentlessly behind the scenes, if only the investor is patient enough to let it operate. This conviction allowed Price to remain calm even when markets crashed or pessimism swept through Wall Street. While others panicked, he focused on the long arc of progress. He understood that great companies often grow through adversity, using downturns to strengthen their operations, acquire competitors, and innovate more aggressively. For Price, short-term volatility was nothing more than the soundtrack of progress, loud, chaotic, and dramatic, but ultimately irrelevant. In a financial world obsessed with quick wins and rapid speculation, Price's long-term view stood like a lighthouse. He encouraged investors to envision not where a company would be next month, but where it could be in 10 or 20 years. This mindset reshaped modern investing and laid the foundation for the growth investing movement. Thomas Rowe Price Jr. left behind a timeless lesson. Find future leaders early, invest with conviction, and let time turn potential into prosperity. Time, patience, and the discipline of compounding. To Thomas Rowe. Price Jr., time was not simply a background element in investing. It was the very stage on which wealth was built. He believed that understanding time was far more important than understanding market trends, news cycles, or short-term price movements. In his eyes, time was the only truly predictable force in the financial universe. It moves steadily forward, indifferent to fear, speculation, and panic. And for the investor who knows how to use it, time becomes a powerful ally. Price often spoke of compounding with a sense of reverence, as if it were a natural phenomenon akin to gravity or tides. He viewed it as a silent, invisible machine, slow at first, then astonishingly fast as the years unfolded. Most investors, he observed, quit too early. They chased rapid gains, jumped between opportunities, or tried to outsmart the market. But Price believed that the most extraordinary results appear only after long periods of patience, discipline, and emotional stability. He compared investing to planting a tree. At the beginning, progress is nearly impossible to see. The seed sits beneath the soil, working quietly, drawing strength, building roots. Months or even years may pass before anything significant rises above the surface. But once the foundation is firmly established, growth accelerates, steep, powerful, and increasingly unstoppable. Compounding, he said, works exactly the same way. Invisible, then undeniable. This belief allowed Price to remain calm during market crashes, recessions, and eras of extreme uncertainty. While investors around him scrambled to sell or reposition their portfolios, Price held firm. Not because he ignored risk, but because he understood the difference between price movement and business progress. A temporary downturn in stock prices, he often reminded his clients, does not erase years of innovation, strong leadership, or expanding demand. Many investors forget this in moments of fear, but Price never did. He insisted that a true long-term perspective required more than patience. It demanded discipline. The discipline to stay invested when markets tremble. The discipline to ignore the noise of predictions. The discipline to trust the compounding process even when it feels painfully slow. His philosophy reshaped the concept of buy and hold. Price did not simply hold stocks. He held visions of what they could become, and he allowed time to turn those visions into reality. In the end, Price's message was clear. Time rewards the patient, compounding rewards the disciplined, and together they build fortunes that speculation never will. The human factor: leadership, integrity, and corporate culture. Thomas Rowe Price Jr. believed that behind every financial statement, every line of revenue, every profit margin, every performance chart, there was something far more important: people. To him, numbers were reflections of human decisions, human discipline, and human vision. A company's true potential could not be measured solely by its past performance, but by the quality of the leadership steering it into the future. Price approached the study of management with the intensity of an investigator. He read every letter to shareholders, analyzed every strategic move, and observed how executives behaved under pressure. Wanted to know who the leaders were when the cameras were off, whether they kept promises, whether they treated employees fairly, and whether they reinvested profits with long-term ambition or short-term desperation. He believed that a company with mediocre products could still rise if guided by exceptional leadership, while a company with great products could collapse if guided by arrogance, carelessness, or weak judgment. He paid attention to what others overlooked. How does a CEO speak about the future? Do they acknowledge risks openly, or do they hide them behind polished optimism? Do they inspire loyalty within the company? Do they have the courage to innovate when everyone else hesitates? For Price, leadership was not just a component of performance, it was the core engine of sustainable growth. Equally important to him was corporate culture, the invisible force shaping how people inside a company think, act, and work together. Price believed that culture could predict long-term performance more accurately than quarterly earnings. A culture rooted in curiosity, discipline, and ethical behavior often produced consistent innovation and resilience. A toxic culture, however, silently eroded a company from within long before the numbers began to show the damage. He made it a rule to avoid companies whose executives chased trends for quick gains. He distrusted businesses that inflated expectations, manipulated short-term results, or followed the crowd without strategy. Leadership, Price argued, must not be seduced by speed. It must be committed to direction. During economic downturns, Price's focus on human quality became even more crucial. While analysts panicked over falling stock prices, he looked to see which leaders stood firm, communicated clearly, and made decisions that protected the company's long-term integrity. Crisis reveals character, and Price invested in character. His conclusion was timeless. Investing is ultimately the art of judging people. Numbers tell the story of yesterday. Leadership and culture write the story of tomorrow, understanding businesses, not predicting markets. Thomas Rowe Price Jr. held a conviction that set him apart from the majority of Wall Street. The market is unpredictable, but businesses are understandable. While others obsessed over economic forecasts, interest rate predictions, and the endless chatter of analysts, Price kept his attention on something far more tangible: how a company actually makes money, sustains growth, and defends its competitive position. To Price, predicting the market was like predicting the weather months in advance: seductive, entertaining, and ultimately unreliable. No chart, no model, no expert opinion could consistently anticipate the next twist of market psychology. But understanding a business, its customers, products, strategies, and long-term economic engine was a discipline rooted in reality. It was something you could study, analyze, and rely on. Price dug deep into fundamentals with almost obsessive intensity. He looked beyond short-term earnings to examine how profit margins were trending over years, not quarters. He dissected product lines, asking which ones created loyalty and which ones merely followed trends. He studied how companies positioned themselves within their industries, who was gaining market share, who was losing ground, and who had the hidden strengths that competitors often underestimated. One of Price's greatest strengths was his ability to see through the noise. When markets panicked, he asked a simple question: Has the company's long-term value changed? Most of the time, the answer was no. Temporary fear did not erase years of innovation, strong leadership, or rising consumer demand. In those moments, Price saw opportunities that others missed. He taught that risk does not come from volatility. Volatility is merely the market breathing. Real risk comes from not understanding what you own. If an investor buys a stock simply because it is popular, cheap, or rising quickly, then every downturn feels threatening. But when an investor knows a company deeply, its competitive edge, its strategic direction, its financial resilience, market fluctuations become far less frightening. Price also understood that industries move in cycles, technology booms, consumer habits shift, economic environments evolve. But while cycles change, solid businesses adapt, they innovate, expand, and refine their strengths. The investor's job, Price believed, was not to predict each cycle but to identify the companies best equipped to survive them. In the end, his message was simple yet profound. Stop trying to outguess the market. Start trying to out-understand the businesses you invest in, because fortunes are not made by predicting the next wave. They're made by recognizing the companies strong enough to ride every wave. Diversification, discipline, and emotional resilience. Thomas Rowe Price Jr. believed that successful investing was not only about choosing the right companies, it was about controlling yourself. Markets rise and fall, sometimes violently, and Price understood that the greatest danger to an investor's wealth was often the investor's own emotions. Fear, greed, impatience, and overconfidence could destroy decades of progress in a single impulsive moment. Price advocated for smart diversification, not the kind that scatters money across dozens of random stocks, but a thoughtful selection of 10 to 25 high-quality businesses. He warned that owning too many companies dulls focus, while owning too few magnifies risk. Real diversification, he said, is about understanding each company well enough to know how it fits into the larger picture. Yet he was equally clear. Diversification was not a substitute for discipline. The true battlefield, Price believed, was psychological. During market crashes, he saw investors crumble, selling their best assets at the worst possible moments. In euphoric bull markets, he saw others chase hot trends, abandoning reason for the intoxicating thrill of quick profits. Price refused to follow either extreme. He trained himself to stay grounded when markets soared and calm when markets collapsed. This emotional stability wasn't natural. It was practiced, refined, and eventually mastered. He often compared the market to a stormy sea. Waves of panic, excitement, hope, and fear crash unpredictably, but the skilled navigator does not abandon ship at the first sign of turbulence. Instead, he adjusts his sails, stays the course, and trusts his preparation. Price viewed disciplined investors the same way, steady hands in turbulent waters. Understanding economic cycles was a crucial part of this discipline. Price knew that economies expand, contract, recover, and expand again. No boom lasts forever, and no recession is permanent. During downturns, weak companies break, but great companies endure and emerge even stronger. Price encouraged investors to focus on which businesses had the resilience, leadership, and innovation to survive storms, not on predicting exactly when those storms would come. Perhaps the most dramatic insight Price offered was this: it is not intelligence that separates great investors from ordinary ones. It is emotional resilience. He believed that an investor who stays rational in the face of chaos will outperform a brilliant investor who panics. Wealth, in his view, grows not from perfect timing, but from consistent discipline, unwavering patience, and the courage to trust one's analysis even when the market screams otherwise. In the end, Price's message was unmistakable. Hold great companies, hold your discipline even tighter.